So next, we're going to talk a little bit about actual tax crimes. All right. So I mentioned before the general standard for fraud, but what about, let's be more specific here. What can you actually, or what can your clients, hopefully not you, actually be charged with in terms of criminal activity? So there's a number of crimes under Title 26, which is the Internal Revenue Code. There's also a number of crimes under Title 18, which is not the code, but relate to tax. And they're very important. I've highlighted some of the big ones here. Now, frankly, there's a lot more than this, but these are just the most commonly charged crimes and the ones that you will most likely run into in your practice and dealing with clients. Some of them should be sort of intuitive, right? Failure to pay, right? You don't pay, criminal failure to pay tax, failure to file returns, right? Filing false returns, aiding or assisting in filing false returns, right? Those should be pretty intuitive. And if you're asking, well, what's the difference? I know there's a civil failure to file and failure to pay penalty. What's the difference here? Well, it's the standard again. These have to be willful, and we'll talk about willful means in a second. This isn't just, oh, they forgot to pay by the deadline and then they paid 9 months late and they get a civil penalty. This is, failure to pay, potentially over a repeated period of time, willfully trying not to pay or willfully avoiding their obligations. It's a very different standard. This is not a forgetful or even a negligent standard. This is a much higher standard to get to the criminal failure to pay and failure to file. Evasion of assessment or payment, that's an important one to remember. Oftentimes where I talk to clients about this sort of on the preventative side is, if you've got a client who's in collection and they're filling out a financial statement to the IRS, the 433A or the 433B. Obviously, those are signed under penalties of perjury, so you always give your client the warning, well, we don't want to be inaccurate or untruthful on this form because that itself could be a violation, a criminal violation for perjury. But in addition, sometimes clients who are facing collection think, it would be a good idea. Let me open a Swiss bank account and move all my money to Switzerland so that the IRS can't collect on the tax liability I owe. Or let me open up a bunch of fictitious entities and put money all over the place so the government can't find it, right? So at some point, that can actually become a crime because you are essentially evading payment of the IRS. Again, it has to be willful. So this is not just mistake or negligence, or they opened up a couple of bank accounts but didn't do it with the intent to evade payment. But you've got to be very careful here. So you've got to counsel your clients, hey, if there's a big liability, you may not want to start moving money offshore and start trying to, because that can look very much like evasion. Another interesting one that I want to just highlight briefly is Title 18, Section 371, conspiracy to defraud. This is called the Klein conspiracy. Comes from a case called U.S. v. Klein out of the Second Circuit from 1957, I believe. So long-standing law. But what this conspiracy basically says is you need two or more persons to conspire to defraud the United States government or agency thereof in any manner for any purpose. And it includes a conspiracy to defraud the U.S. by interfering or obstructing lawful government functions through, quote, dishonest means. Okay. Now, of course, the main requirement of this has got to be two or more people, right? The benefits of this particular statute are statute of limitations, because what happens here is the statute of limitations on most tax crimes is 5 years. So if the government doesn't catch it by then, you're sort of scot-free, or the taxpayer is scot-free. Well, with the conspiracy charge added on, the benefit for the government is that the statute runs from the last affirmative act to continue the conspiracy. In other words, let's say the taxpayer 6 years ago filed a false return, engaged in true tax evasion. Okay. Well, 6 years have gone by. They may be outside the statute of limitations for failure to pay or filing a false return, right? They may be outside those statutes. But if the taxpayer and some other person conspired to, maybe there was an audit later on, or there was an inquiry from the IRS, and they conspired to to sort of hide the ball from the IRS to prevent the finding out of the fraud that was engaged in 6 years ago, that last affirmative act to support the conspiracy, that's when the statute runs. And so the government, even though they may be not able to charge something on the left side of your slide, the Title 26, they can charge conspiracy because it's still within the statute of limitations. So it's a powerful tool for the government to potentially use depending on how long ago the fraud was committed. Now, think about it. If the government needs two people to have a conspiracy, and they've got the taxpayer. They believe the taxpayer committed fraud. Who's a likely source for a co-conspirator? Us, right? Tax professionals, right? Maybe their tax advisor, their financial advisor. So again, it can be an area when we talk about ethics later, just keep in mind, you never want to be the co-conspirator with your client because you don't want to be named in any kind of indictment. Now, for all of these crimes, one thing that's required is willfulness, right? So criminal, this is sort of basic constitutional law. Criminal acts require some element, generally speaking, of willfulness. What is willfulness? According to the case law, it's a voluntary, intentional violation of a known legal duty. There's lots of ways you slice and dice that in specific situations, but of course, the main thing is it's got to be intentional and it's got to be a known duty. Now, I will tell you, in various contexts, the ability of the government to prove a known legal duty is fairly robust. In other words, it's not generally, in most contexts, a good defense for a taxpayer to say, well, I didn't know that I needed to file a federal income tax return, or I didn't know that I had to report something on a particular schedule, right? Because when a client signs their return, right, what does it say, right? They are deemed to have knowledge. They've read through the return and the instructions, right? And so a lot of times the government will say, well, okay, you're saying you didn't know about it, but you signed the return, you're imputed with knowledge of everything that's on that return and all of the instructions therefore, so you should have had knowledge. So knowledge can be fairly easy to prove, even for relatively obscure provisions of the code. Intentional violation can be harder to prove, right, versus careless, reckless, negligent, or a genuine good faith mistake, right? That can be a little bit harder to prove. So some examples from the Internal Revenue Manual of what agents are looking for in terms of willfulness: lying to, concealing information from, or disregarding advice of tax preparers or professionals. Intentionally failing to maintain accounting records, that can be a potential element of willfulness. Obviously, this is a big one, keeping a double set of books. So if your taxpayer has the real books versus the books they showed to their preparer, that's obviously a very bad thing. Filing false returns or documents with the IRS, responding to IDRs in a way that is false, information document request, that can obviously be an indication of willfulness. Lying to IRS agents during the course of an audit investigation, that's a big one, of course. Extensive use of cash to conceal financial transactions, that's an indicator. There are still some areas of business where they operate mostly in cash, and in those cases, generally, this is not considered a sort of a badge of fraud. Use of nominee shell, alter ego, entities, or individuals to conceal income or assets, that should be pretty straightforward there. Structuring transactions to avoid reporting. Use of foreign accounts to conceal income or assets. Those are all things that the IRS has in their guidance that are examples of potential elements to prove willfulness. All right, so I've mentioned this a little bit already, but where do criminal cases come from? Their primary source is from the civil side of the house. In other words, they're primarily coming from fraud referrals from compliance, examinations, and collections, where those revenue agents or revenue officers see something that looks like fraud, and they sort of send it up the chain, and that's where they get into, that's how the criminal case originates. Whistleblowers and informants, the whistleblower law has been progressively getting more favorable, where people can blow the whistle on a tax, someone that they feel is avoiding tax. A lot of times that's employees blowing the whistle on their employers, but not always. And those do lead to criminal investigations on occasion as well. Special projects that the IRS is running, if they've targeted a particular scheme or tax strategy they view as potentially abusive, that can lead to criminal cases. Other law enforcement agencies, and actually one thing that should be on here is state tax authorities. Many states have criminal state tax enforcement and will refer cases to the IRS once they've done their state level investigation. One of the targeted areas for criminal enforcement is employment taxes. So, many of you are probably aware, you probably see trust fund recovery cases on the civil side, where an employer is collecting, withholding from their employees, and they're supposed to remit that to the government for payroll taxes, and they simply don't do it. They use it to, in the most egregious cases, buy themselves toys, yachts, cars, whatever the case may be. Or in the more sympathetic cases, they just use it to keep the business running. And on the civil side, there's civil liability for anyone who's a responsible person. In other words, people who have responsibility for collecting and paying over tax but fail to do so. There's also criminal exposure, which in the past really hasn't been something the government prosecuted on with that great frequency, but now is becoming much more something that they really are focusing on. And, when there's the civil side inquiry and there's a potential for the IRS civilly to look to collect from someone, not from the company, but from a responsible person, they have this interview where they go and they talk to them to make a determination if they're responsible. Those can actually prove to be very useful in subsequent criminal proceedings, right? So if you have a taxpayer that is being interviewed as a responsible person, and it looks like some real potential fraud issues, you may want to say, I'm not sure you should do this interview, because if this looks like it might go beyond civil, what you're saying here could be used against you in a criminal proceeding. And it's a good time to consult with a criminal tax attorney because, again, you just don't want to box yourself in. In addition, you'll see some of the notices coming out notifying employers and responsible persons of potential liability for employment taxes. We'll talk about the criminal exposure, and they'll say if you don't, remit your employees' taxes, you could be held criminally responsible. Those are later used in criminal cases to say knowledge. They must have had knowledge because we gave them this notice, and in big bold letters it says you're subject to potential criminal exposure, and that's something that the government has introduced as evidence of willfulness. So just something to keep in mind there. So let's talk a little about criminal enforcement and sort of continuing on with the sort of employment tax. I want to highlight one thing, which is 26 USC 7202, willful failure to collect or pay over tax. This is any person who's required to pay with tax, like the withholding taxes, and doesn't do so, may be guilty of a felony up to 5 years in prison. Okay, so this is no joke, and DOJ is really looking at these cases. There's been a couple enforcement developments on that side. The primary one is really the way that DOJ internally thinks about these type of cases. Like I said, in the past, most of this was handled civilly, right? Failure to remit employment taxes was a civil issue. Well, not anymore. And the DOJ has made that change clear internally to their own attorneys and their own manuals. And they also made an interesting change to the sentencing guidelines. The sentencing guidelines are what the courts, judges, probation officers use to determine how long a sentence will be when someone is convicted of a crime. And there's a tax sentencing guideline that's specific to this world. In the past, the sentencing guidelines said that for the failure to remit employment taxes, those violations are, quote, infrequently prosecuted. And judges, when they were sentencing clients, hung their hat on that to reduce sentences because they said, look, these things are infrequently prosecuted. It must not be that big of a deal. People don't know about it or for whatever reason. And defense attorneys could use that language to basically tell the court, you need to depart. If the guidelines say that the prison term for the amount of tax avoided is, 24 months, look, this crime is infrequently prosecuted. So give them a break. They didn't know about it. They had no reason to know about it. And let's get probation. And that was happening. And so DOJ went and said, look, it's not true anymore. They went to the Sentencing Commission. They said, we need to delete that phrase because prosecutions have grown. There were just 3 cases under sort of the employment tax willful evasion in 2002, 46 cases in 2014. So the Sentencing Commission recommended that they'd strike that sentence, and so that's no longer a good argument. But you can see this is a targeted area as it is increasing each year in terms of how many people are prosecuted.